Ladies and gentlemen, good day and welcome to Shri Keshav Cements and Infra Limited Q1 FY25 earnings conference call hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Jainam Salwa from Kirin Advisors. Thank you, and over to you, sir.
Thank you. On behalf of Kirin Advisors, I welcome you all to the Shri Keshav Cements and Infra Limited Q1 FY25 conference call. From the management team, we have Mr. Venkatesh Katwa, Executive Director and Chairman, Mr. Vilas Katwa, Managing Director. Now I hand over the call to Mr. Venkatesh, sir. Over to you, sir.
Okay, everyone can hear me, right?
Yes, sir.
So good afternoon, everyone. Warm welcome to this con call for Q1 FY25. Welcome and thank you for joining the conference call of Shri Keshav Cement and Infra Limited. We are delighted to have each one of you here as we explore and discuss the financial performance of Q1 FY25 of Shri Keshav Cement and Infra Limited. So before we dive into the details of this quarter, let me offer a brief overview of our company and its robust business model. Shri Keshav Cement and Infra Limited, what was formerly known as Katwa Udyog Limited, is engaged in manufacturing of cement and generation of renewable power and distribution of cement and power in the state of Karnataka. The cement plants are located at Bagalkot district in Karnataka and solar plant is located at Koppal district in Karnataka. The company supplies cement in North Karnataka, Coastal Karnataka, Goa and some parts of Maharashtra. The company has a network of 350 cement distributors and over 600 retail sales points and over 14 solar power consumers. Since April 2018, the company has been meeting 100% of its energy requirement through renewable solar energy. The cement plants of SKCL are likely the only ones in India to run on 100% green power, resulting in almost 80% or 90% reduction in the power costs. We received a prestigious award from the Bureau of Indian Standards recently for achieving a consistent high quality cement production with zero product failures. As far as the rating is concerned, the company's rating has been improved from BB plus with a stable outlook to BB plus with a positive outlook. So we're delighted to share some positive updates regarding our capital expenditure, the CAPEX plan, which was aimed at debottlenecking, expanding and modernizing our capacity. The new cement plant is set to be commissioned by fag end of Q3 FY25 with construction completion target in the end of November or beginning of December 2024, resulting in a total capacity of 1 million tons per annum. Solar generation capacity was enhanced by 3 megawatt and we have commissioned another 3 megawatt by April 14, 2024, and the power generation will increase by around 45 to 48 lakh units, which is roughly about 8 to 9%. Upon fully being commissioned. We strategically position the company to increase its market share to its existing 250 plus to 300 kilometer radius by expanding our rural network and supplying to larger clients. We also plan to enhance our capacity utilization to 60% in FY26, 70% on FY24 and higher thereafter. 60% is what we are talking on the CAPEX capacity. So currently we have reached 70% for current CAPEX. So we are definitely very excited to announce the commissioning of the 3 megawatt at Bisaradi in Koppal, Karnataka. So our total solar capacity has increased from 37 megawatt to 40 megawatt. This expansion marks another significant step in our journey towards renewable energy leadership, reinforcing our commitment to sustainable growth and long-term value creation. Our commitment to excellence is reflected in recent accomplishments. including recognition from the Bureau of Indian Standards to be for maintaining the highest quality of cement. The strategic CapEx initiatives combined with reduction in the cost of fuel and power consumption are aligning favorably, setting the stage for a promising growth prospects for the remainder of FY25 and beyond. The company aims to reach a million ton capacity, like mentioned earlier, by end of Q3 FY25 through technically major improvements, which will help us to pay off the major debts. The power will be used for self-consumption, and currently about 35 to 40% of the power is used for self-consumption and 65% outsourced. But with the CapEx, almost 95% of the power generation will be used on self-captive basis. So let me take you through our performance for Q1 FY25. In Q1 FY25, company has reported a strong financial performance with consolidated total income reaching about 31.24 crores. The company achieved an impressive EBITDA of 8.06 crore, reflecting a robust EBITDA margin of 26.5 crore. PAT stood at about 1.78 crore, resulting in a PAT margin of 5.7%. Additionally, the EPS for the quarter was 1 rupee 14 paisa. So looking ahead, we anticipate additional benefits of economies of scale as we triple our plant capacity, achieve higher utilization rates, and enhance our solar capacity. These improvements, coupled with a robust outlook for cement demand, will further enrich our performance. Our aim is to ensure sustainable business growth and strengthen our market position with the continued focus on expanding our brand. So as we approach our question and answer session, I wish to convey my sincere gratitude to all our stakeholders. Your unwavering support and active involvement has been integral to our growth story, playing a crucial role in our success. We genuinely appreciate the significant contribution each one of you have made. With this, I am pleased to open the floor for any question and answers. Once again, thank you for your presence and ongoing support.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Manan, an individual investor. Please go ahead.
Yes, thank you so much for this opportunity. Can you hear me?
Yes, ma'am, we can hear you.
Yes. Really pleased to hear the results and congratulations. I've been an investor for quite some time. So yeah, I just wanted to I just had 3 questions. So wanted to understand that we said that we have around some more than 350 clients or something. So did we win any new clients this quarter? Can you name some of them?
I wouldn't have the names right off my desk. If I had this question, probably I would have gotten them. But typically, all these 350 retail dealers are within the area of these 200-250 kilometers. I will have to really check the records to see who has been actually added to that list.
Okay, so how many were added this quarter that you don't have as of now?
No. And I wouldn't think this quarter was a very good quarter to add any cement dealer because of elections and everything else. The cement market was pretty pressurized. It was almost a buyer's market.
Okay. Second question would be that, for the past few quarters, we are saying that we have more than 600 retail touchpoints. So, are we increasing on that front or like this quarter, did we increase this quarter as well or no? Because, for the past few quarters, 600 के आसपास आप बोल रहे हो, इसके लिए मैं जानना चाहता था.
So typically, what happens is when we have the dealers in a certain area, certain geographic location, it may not be possible to add another dealer in the same location unless we have because it is like, having our own 2 dealers compete among ourselves. So there is general rule that if the dealer is as small as if someone consumes just like 10 to 20 tons per month, I'm talking about the smallest of the dealers, the rock bottom, 20 or 30 tons or maybe 50 tons a month. is a small village. There is no scope for us to add another over there. Unless, even if we add it, it is not going to increase our sales. Rather, it will get divided into retail touch points. So what we intend to do when we are talking about the capex plans is basically we will start hitting on to the bigger dealers. Currently, we are not able to supply to them because we are not able to give longer vision on the pricing and the quantity. Apart from that, we will also start supplying to major, non-cement dealers like institutional consumers and the government contracts. We have got clearance from most of the government project works or wherever we applied. But again, because of long-term, pricing required and long-term, the kind of quantity required, and of course the deep discounts we were not able to offer it earlier, which we can offer it after the capex come into place. But there is a continuous effort. We have increased the sales force and we have increased our reach, outreach. We are talking to new people. It's just as a phase we are going through that process right now.
Okay, that was really helpful. So, okay, I wanted to just a follow-up on this. So let's say we commission our 1 million ton capacity and everything. So how many distributor clients are we aiming for and how many retail touch points are we aiming for? Like sort of, like going how much, मतलब कितना ज़्यादा जाना चाह रहे हैं 600 से like 700-800 जाना है, फिर 300 से मतलब 400 जाना है या कुछ ऐसा कुछ बता सकते हो आप?
So figuratively, it might be very difficult to comprehend a certain numerical number. But what I can tell you is, for example, if we reach out to place like Pune, one or two dealers is sufficient. They will have sub-dealer network and which we don't count among these numbers. So one or two dealers will be more than sufficient to pick up almost like 20-25% of the new capacity. Similarly with Bangalore also. So what we are aiming at is going deeper with the existing retail outlet. So for example, I have a small dealer in some place which is doing about 50 tons. We will have to provide a marketing and a sales support for him to increase from 50 to 100 tons. That we can do with the higher EBITDA margins and higher cash flow generation after the capex, which we are not able to do right now. So numerically speaking, we may not look at going farther or whatever. We are more be thinking of going deeper, increasing our market share. Since our brand is known in this 200 to 300 kilometer radius from our plant.
Okay. And are we seeing any traction from Andhra Pradesh, Tamil Nadu, Telangana, वो side पे कुछ हमको मिल रहा है orders या कुछ?
No, the nearest from a border from first state is Goa and Maharashtra. We are settling out there. Telangana would be too far for us because then you have to cross the cement cluster area. Then yeah.
Okay, understood. That's it from my side. Thank you so much.
Thank you, ma'am. Yeah.
Thank you. Our next question is from the line of Tushar from Yuga Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. I have a couple of questions. So, considering the consolidation that is going on in the southern industry right now, smaller players need somewhat of a capacity of around 3 NTPF to make economic sense and to be able to compete on prices. So, how do you plan to survive as bigger players price themselves more aggressively going forward?
So, two aspects are going to help us. One, our plant is located close to the consuming market. Basically, most of the larger plants are not close to the consumer market. They're housed in the area where the plenty of limestone is available, where all the major cement plants are located together. For example, if we have to supply to Goa, my logistic cost to Goa is about 1,000 rupees approximately. They have to spend more than 2,200 rupees just to reach to the same location. So I already have a location advantage. Plus, I have a renewable power which is generating power to me at less than 2 rupees, whereas most of the larger cement plants, even if they have their own waste heat recovery and thermal power plants, the fuel price is still very high. So there's a huge delta for me to recover from that. Because of these two factors, we are able to not only survive, we are able to have significant inroads in these kind of markets. And consolidation, I have noticed when the number of players are reduced, it does bring certain kind of price discipline in the market. So I feel that a consolidation would rather give a better margins to us rather than other way around. In short term, yes, it is going to be a challenge because the larger players want to capture the share. But then when all the smaller players are eaten up by these big players, we are going to see a lot of pricing discipline, which is going to be a great benefit to us. So again, our location advantage is unbeatable. Our power cost is unbeatable. And with the modification that we are doing right now, on EBITDA per ton margin, we are going to be at par with them. So, and there are going to be customers who will always buy certain branding for certain pricing all the times. So I hope, that, and our capacity is not very significant. It's just 1 million tons. So, I would have been really worried if I had a 5 million ton plant where, selling such a large capacity would be a challenge. But I would say within 300 kilometer radius, almost 30 to 35 million ton cement is consumed. So 1 million ton would not be very significant for that area.
So can you please repeat that? How much is the consumption demand in your area?
About 30 to 35 million tons.
That's annual?
Yes. In the 300 kilometers belt where what we're looking at, a significant consumption.
Okay, sir. And so as you mentioned that there are a lot of bigger players acquiring smaller players. So what are your thoughts on it and what are your plans regarding this?
So as such, we don't have any specific plans. We have been approached by some larger plants for having some kind of a partnership, but it hasn't concluded in any kind of a confirmed deal yet. But, at some point in time, if there is a business sense for us to partner with them, either in the form of white labeling or anything similar to that, companies will be open to looking at it. Otherwise, I feel this consolidation is at some point in time is going to help smaller companies like us, because a price discipline would be a great benefit for us.
Okay, sir. And so prices of bag have fallen a lot recently, especially in the southern region. So how long do you expect this trend to go on for, and how will this affect your revenue growth and profitability going forward?
So definitely the price reduction has had a huge impact on my Q1 results. In spite of my capacity utilization going up from 62% in Q1 FY24 to 70% in Q1 FY25, in spite of this 8% jump, or 800 basis points jump, the revenue has remained stagnant and it has hit the PBT only because the prices have reduced by over 12%. So I'll give a general math. We use a word called naked cement rate. Naked cement rate is the price at which it leaves the gate of the plant. It excludes any kind of logistics outside the gate. It excludes any kind of taxes, anything. So what is net realized within our gate of the plant? I will give an example. It used to be 3950 in Q1 FY24. It is now 3475 in Q1 FY25. Almost like 12% dip in the pricing. So 12% dip in the pricing is almost like 500 rupees per metric ton. So for about 62,000 tons what we have dispatched, losing top line here is like losing bottom line itself. So if you look at the basic math, we lost almost 3 crores on top line, which would have reflected in the bottom line just because all other costs would remain intact irrespective. So yes, the Q1 has been impacted by, in spite of higher dispatches, we got impacted by lower pricing. So regarding South, yes, there is still a challenge. But again, in the past, if you look at the history, whenever there has been a depression in the prices, it has eventually averaged out better compared to the previous years. It has been a system if you look at last 5-year data. So similarly, if that holds true, we're expecting the cement to turn around in the first week of October or maybe last week of September.
Okay, sir. I have one more question. Is there any cement plant or facility in a 300-kilometer radius near you? Because as you mentioned before that you have vast supplies of limestone near your facilities, but there don't seem to be any cement buyers for them. So what is the reason for that?
So there are a couple of other plants, but they have their own captive mining. We are the only plant in that region where we have mines, but we are not able to extract it because of legal challenges with the surface rights of the land. But that's a different subject. So as of now, since we have taken over the plant, we are purchasing limestone from the 20 odd mining, small to medium mining organizations, and we are the only buyers. They do sell limestone to some other plants little far away, but the limestone for those plants, like in steel and other plants, they are used as some kind of an a catalyst or an additive, not as the main raw material. But for cement, limestone being the main raw material, we buy the bulk of it, and we are the only buyers in that area right now.
Okay, sir. And as you mentioned, there are a couple of plants in your areas that they have own mines. So are they tier 3, tier 2 brands like you, or are they bigger players?
They are bigger players. They are tier 2 players. One is JK and one is Dalmia. So they are located about within 20 kilometers from us.
So can you please repeat that last part again?
There are 2 cement plants which are of tier 2 level within a radius of about 25, 30, or maybe about 50 kilometers.
Okay, sir. Okay. Thank you, sir.
Sure.
Thank you. Our next question is from the line of Amit Dubey from New Valley Capital. Please go ahead.
Hi. Thank you for the opportunity. So my question was regarding the consolidation part. So I'd just like to know in short, like if you get the opportunity to sell out the business or you get any buyers, so at what valuation would you be comfortable selling it? And one more question is regarding the debt. So at what debt to equity in future you're targeting? Because you'd like to be flexible with the finances, right? I mean, so is there any target that you want to keep certain debt to equity to be comfortable?
Sure. So first, at the valuation, at what valuation we would like to exit, it is really a very difficult question to answer because we haven't got any such suggestions. Basically, what is happening is even when we are approached by larger plants, it hasn't gone to the level of discussing the financials. I feel that as an organization, we can continue to grow. I don't see a very specific advantage in selling out the plant. Rather, we would keep adding more capacity as and when we keep growing and try to take our capacity at a very high level. Apart from this location, we can add more facilities in other areas. But if you ask me at what valuation we would quit, I don't even have a ballpark figure. If there is a good price, management is always going to consider it in the best interest of the shareholder. So regarding debt, if you look at my debt profile, it is less than 2 on the books, which we feel is very comfortable. But yes, once this capex goes online, one of the main reasons we are doing the capex is to improve the EBITDA margin of cement. For example, last year we did an EBITDA per metric ton of 200 rupees, whereas industry is averaging about 1,000 rupees. This is mainly because our power consumption is almost 50-60% higher than the industry standard, and even the fuel consumption is also 50-60% higher than the industry standard. Once that has been arrested, this cost saving itself will translate into adding about 800 rupees EBITDA per metric ton, which means typically we will reach between 900 to 1100 EBITDA per metric ton at par with what we see in the industry. So once we come to that level, there are going to be sufficient cash flows. Unless there are new plans, we will be utilizing those funds to cut down on our debt. So does that address your question, Amit?
Yes, thank you.
Thank you.
Thank you. Our next question is from the line of Bharti Patel from CD Consultancy.
Hello, Bharti here.
Yes, ma'am.
So please, can you please tell us about the production and sales volume of for the Q1 FY25?
Definitely. So our production for Q1 FY25, I'll just wrote down the figures here. Yeah. So production is around 63,000 and odd. and sale is about 63,772. This was in Q1 FY24, it was 55,991. So you'll see that there is a 8,000 tons jump in the sales. But in spite of that, the top line remained very similar because of the, almost 12% jump in the sales quantity, but 12% reduction in the sales price, which is why it did not see any impact on the top line or the bottom line.
Okay, sir. Understood. And what is the current capacity and capacity utilization in the business?
So right now, my capacity utilization for Q1 is 70%, and the capacity itself is about 0.35 million tons.
Okay, sir. That was it. Thank you.
Thank you.
Thank you. Our next question is from the line of Aditi Roy from Patel. Please go ahead.
Hello,
Aditi ma'am, your voice is very slow. I request you to use your handsets while asking a question.
now am I audible?
Yes.
Yes.
Congratulations, sir, and thank you for giving me opportunity.
Sure.
The Karnataka market has the capacity to absorb the rise in the cement production considering the competition in the market?
Sorry, I think I missed the question part. Come again with the question.
Does Karnataka market has capacity to absorb the rise in cement production considering the competition in the market?
Yes. Typically, when we say Karnataka, it's the southern zone. As of now, we are over capacity across all the regions, and southern zone has been much more higher than the other regions. But we are at the northern tip of the southern region, which means that our outreach is going into Goa as well as southern Maharashtra. Not all our cement is sold in Karnataka. So in spite of the higher capacity available and the huge capacity expansion, we are closer to the consumer market compared to most of the capacity expansion where it is taking place. So in Karnataka, most of the expansion is taking place in the cement cluster, which is known as Gulbarga region. But in our region where we are located, the only capacity expansion is done by us. And since we are closer to the home market or the consumer market, we are not likely to foresee any kind of resistance from the larger plants, unless it is a little bit of pricing, which we are able to compete with them.
And sir, I have another question. Can you please explain our leadership network in increasing FY25?
So when you say leadership network, I am not able to understand the question.
Leadership.
Dealership.
Yeah.
Okay. So.
Dealership, sorry.
Yeah. So typically what has happened is we are already focusing on increasing our market reach by reaching out to the existing customers. We have hired a few people to reach out to areas little, deep into the Maharashtra, going a little south in Karnataka. And as such, we have hired some experienced people. But right now we are only focusing on, getting to know them. And we have already supplied some sample products or beginning to, send some cement in that region. But since we do not have enough capacity and the logistic cost is going to be too heavy, with the current EBITDA margins, we are a little restrictive in what we can achieve. So once this, capex comes into play, our cost of production goes down. There is a huge scope for us to start, digging deep and expanding our current market share from the existing areas as well as adding new areas. So that's the kind of plan which we are implementing right now, and we are very confident that it will go successful and we should be able to achieve our required targets with these kind of efforts.
Okay, sir. Thank you, sir.
Thank you, Abhijit.
Thank you. Our next question is from the line of Bharat from Fair Value Capital. Please go ahead.
Hi, thanks for the opportunity. There are a couple of questions from my side. So when you refer that there are couple of companies who are also operating in the similar league where they have capacities near our facility. So can you help us understand what will be the overall kind of a production levels which happen by both the companies, JK and Dalmia, in the region?
So right now, I think both of them put together is about 5 million tons, and ours is going to be 1 million tons. So together we are about 6 or maybe 6.5 million tons as I see of it right now. So they have been a similar capacity in the last 3 to 4 years. I have not heard about any kind of capacity expansion going on out there right now. Although I would not commit on saying what is happening, because unless it comes out in the media, we will not be able to find out. Nevertheless, beyond 5 million ton in such a market, I would not say it's not very huge. So if you look at Gulbarga, I think so they will have a capacity of more than 100 million tons between many large plants over there. So we, with this 5 million tons, we are pretty confident that together we can serve these markets.
And sir, with respect to the overall supply which we do, like in the 250 odd kilometer radius, what will be the overall level of consumption of cement out there in the vicinity?
So an approximation at 300 kilometers radius from our plant would be consuming around 30 million tons. So for example, the whole country is consuming about 375 to 317 million tons last year. So, and ours is big, in the 300 or 350 kilometer radius, more than, based on per capita consumption, it is estimated that about 30 million tons is getting consumed here.
And so with respect to the guidance, like you mentioned, 900 odd will be a EBITDA figure per ton for, I think, from FY27 onwards, we'll be able to enjoy this particular margin. So in a way, with respect to 1 million ton capacity, it can lead to a 90 crore EBITDA, if my understanding is correct. Right. Whereas you try to mention in previous calls that the EBITDA overall for FY27 can reach to near about 120 to 150 odd crores. So can you help us understand the discrepancy out here?
Absolutely. So when I say EBITDA per ton of cement, so for example, when I calculate the EBITDA on per ton of cement, it is typically on the basis of excluding the benefits of solar energy. So when I'm calculating EBITDA right now, when I say 200 rupees per metric ton, it is exclusively for cement vertical, without taking into consideration the benefits of solar energy. For example, the last year EBITDA was around 42 crores. Out of that almost 36 crores EBITDA was due to solar. Hardly about 5 to 6 crore EBITDA belong to cement. So that 35 crores EBITDA what we are earning in solar will continue to accrue. So when I must have told 90 crores EBITDA, it must be purely for cement, and then you have to add about 35 crores of EBITDA for solar will generate. So overall on the financials, you will see 100 plus EBITDA. But one thing I'll tell you, typically when we discuss on EBITDA at a particular time, let's say when we were discussing this on Q1 of FY24, that time the pricing of cement was around 4,000 rupees. And it was expected to go to 4,200 or 4,300 based on the general understanding on past 5 years CAGR. So based on that, at 70% capacity utilization, you would reach around 85 to 90 crores or maybe 80 crores on cement plus 35 crores EBITDA. So in a nutshell, assuming that price will continue to grow at the inflation plus certain level, what we have seen in the 5 years, in FY27, yes, with cement and the solar, we should be able to, reach around 120 crore EBITDA without any doubt.
Sir, my understanding was we'll be utilizing 95% of the overall power consumption itself for the capital. So I think the benefits of solar the benefits will likely to go down. But in a way, what you are referring is incrementally it will be there. 35 odd crores which we are currently generating, that will be there. And that will be reflecting in the EBITDA from FY27.
So that is only for example, to do an apple-to-apple comparison. For right now, I'm generating around 1,400 rupees EBITDA per metric ton. If you look at my balance sheet, my entire EBITDA, for example, my first quarter, my total EBITDA is around more than about 8.8 crores. I'll just give an example, right? For about 63,000 tons of dispatch, I'm showing an EBITDA of 1,400 rupees per metric ton. But that would not be accurate because out of that 1,400 rupees, most of the benefits have come because of solar. Even though I'm consuming solar 95 to 90, assume I'm consuming 100% of the solar energy. Power I'm going to get free of cost. But when I was mentioning 900 or 1,000 rupees EBITDA per metric ton, that is assuming power at the market price. So based on that, we were targeting about 900 to 1,000 rupees because that would be a correct apple-to-apple comparison with the other companies. But no other company has got 100% renewable power on their system. So when I was saying 900 to 1,000 EBITDA per metric ton at 70-75% consumption, we are likely to hit about 75-80 based on what I see right now. Plus 35 crore EBITDA of solar will add to the figure just because the market price of the solar at that particular point in time will lead to addition of this. If I don't do that, it will automatically become 100 to 120 otherwise also. And I hope I'm able to make you understand why I'm differentiating these two.
Right, sir. Got it. And the last question is, sir, recently there has been a ruling from the Supreme Court in regard to the imposition of tax. So, for our industry where we procure a large amount on the limestone front, so don't you think there will be a pricing point faced by the industry going forward if the Karnataka state government imposes a tax further on the same?
Tax on what?
Like on the minerals front, on the mining front. So for those companies who are backward integrated to a greater extent, so they will be facing some sort of a headwind coming in from the tax authorities if the imposition is being done, because it will be backdated from 2005.
So if you are talking about royalty, it is going to be applicable to everyone generally, and till date, generally we have not seen anything happen retrospectively. So if there is something in future, most of these taxations are common whether you are captive or non-captive. Of course, captive does have an advantage, but then limestone itself does not part a significant cost proportion in your manufacturing cost. It will be surprising, but by volumes, limestone is 95% of your volume in cement. When it contributes to cost, it is less than 15%. And almost 70-75% is contributed by power and fuel, which is where we are addressing our issue. So if there is some additional tax which is going to be likely to come to us, of course, there is going to be some impact on the company, but I'm assuming that the tax will be applicable to all the mineral extraction irrespective whether we are buying it or we are consuming it from our own resource. Because typically in the past, this is how it is working. The royalty or any kind of tax, it is applicable irrespective of whether you're selling it or you're extracting for yourself.
Right. And sir, a last bit, like in terms of the overall capacity which is there, so 1 million tons is definitely where we are looking forward. But beyond which, do we have any scope for further, you can say, expansion within the particular area, or are we also evaluating out opportunities post the stabilization of it? So any roadmap which we have for the next 5 years?
So as of now, we are settling for this 1 million ton. Of course, with the kind of kiln that we have purchased this time, we are basically replacing the kiln which was not part of our original plan. So the new kiln is designed in such a manner that tomorrow, if we have to do any kind of additional expansion or brownfield expansion, it can increase to about 1.8 million tons by simply adding another grinding and crushing equipment. But as such, to be honest, we haven't decided on that yet, but sometime in the future we will take it up. When we will take it up, I do not have an answer, nor do we have a roadmap as such. For now, we are sticking with completion of this project and making sure that our debt starts coming down before adding new capacity in cement as well as in solar. But there is definitely a plan from the management side to increase capacity in both the verticals.
Right. That's it from my side, sir. Thank you so much.
Thanks a lot, Bharat.
Thank you. Our next question is from the line of Amit Dubey from New World Capital. Please go ahead.
I just wanted to know about the outlook. What do you think, like this fall in prices? Do you think it is temporary or it will have it will take a lot of time to get that. As we are in the higher interest rate environment, once the interest rate eases, will the prices go back to normal, or what is your outlook on that?
Amit, I could not hear the question because there's a lot of, I felt there's a lot of echo. So can you go a little slow, maybe I don't know why. The last question also had a similar challenge. So I could hear few words, but not a sentence in full.
Okay. So mine was on the outlook. The cement prices that have fallen, do you think it's a temporary issue or it will last for a bit as if environment interest rate comes back to normal? Do you see prices going up?
Definitely, yes. So you're talking about the pricing. Without any doubt, I mean, the pricing has to improve going forward. Cement industry has seen this kind of dip many times in the past also, and no one has sustained for long with this kind of pricing. Pricing is pretty bad. You have seen this across all the plants all over India. It is mainly because we had a national elections going on in Q1 and Q2 was completely, Q2 started off with a lot of monsoons. There was attempt by the cement owners to, I would not say out of any kind of grouping or whatever. Typically, a tier 1 brand increases the price by about 1,000 rupees per metric ton. Everyone follows suit. They did try to do that, but within a week it started collapsing back. Mainly because there is no consumption at the bottom level. Because of elections in the Q1 and of course monsoons now we see in Q2. But yes, once they're all settled right now, the government is back in the saddle. There is lot of basically government is focusing on adding 3 crore houses, the infrastructure. With the kind of unemployment noise that has gone through the country, there is an expectation by the industry that the government focus on a construction industry which apparently generates the highest employment. And, with this, we are expecting the general consumption to improve. A little pull from the market will, beef up the pricing. So I'm very confident that by the end of September, we should be able to see some recovery in prices to normal and even better. And one more thing, see, in the last many years, if you look at it, average pricing has always been on the higher side compared to the previous year. So even though we lost the pricing in Q1, Q2, if the previous trend has to continue, Q3, Q4 are likely to be extremely good.
Thank you.
Thank you, Amit.
Thank you. Our next question is from the line of Tushar from Yoga Capital. Please go ahead.
So thank you for the opportunity again, sir. I have a couple of questions. Can you please guide what your consolidated EBITDA per ton will be after the expansion in FY26 and 27? And also please provide a breakup between an apple-to-apple cement EBITDA per ton and including solar.
So basically, when we do an apple-to-apple comparison, is when others are manufacturing cement from either thermal power production or purchase from the discoms. There's not much of a cost difference between today's with the kind of coal price going up. So assuming that as a base, industry is generating about 1,000 to 1,100 rupees EBITDA per metric ton. With the same statistic, if I do not assume that we do not have a solar with us, we are generating about 200 rupees per metric ton. So there is a huge gap of 800 rupees. So once that is recovered due to this capex, what we are doing right now, when we may not reach the 1,100 like the largest industry, but we are pretty confident to reach around 900 to 1,000 rupees EBITDA per metric ton. So once that reaches, we become at par with the industry. In addition to this, so we will have an EBITDA of another 35 source from solar itself. But since we are entirely consuming it to ourselves, we are going to add another 200 to 250 rupees EBITDA based on that. So our total EBITDA is going to be between 1,250 to 1,300 rupees, including the benefits of solar. So that's the target, and that's the ballpark what we are kind of looking at.
Okay, sir. And sir, in your previous calls, you have guided a per ton fuel consumption of around 750 to 850 kilocalories post this expansion, whereas industry standard is around 650 kilocalories per ton. So any reason why even after modernizing your plant, your per ton fuel consumption will be more than industry standard?
So industry is not exactly 650, but the best industry must have reached about 680 or so. But on average, industry standard is about 700 to 750, I would say. And I think that I've heard about it. The top class industry, they have reached about 680. Maybe I don't know how I messed up the figures, but it's typically 700 to 750. We would be reaching between 750 to 850, maybe higher because of economies of scale. So our cement, even though we are putting the best equipment, it's like you're making tea in a small pot as opposed to a big pot. They say always the big pot tea is more tastier, something like that. So when you have a much larger scale, some benefits are going to accrue with that, which we will not get the benefit of. So that's the reason there is going to be a difference of maybe 50 to 100 kilocalories.
Okay, sir. And sir, you recently commissioned a 3 megawatt solar power plant. So what are the terms for the payment? Because you mentioned something about your supplier paid for it or something of that sort. Can you please mention the terms?
Terms from what?
Terms of repayment.
Terms of repayment to the bank?
So you mentioned that the 3 megawatt solar addition that you've done recently, the entire project was financed by your supplier, not by you.
Correct. Yes, you're right.
So what would be the terms?
So repayment is for 5 years. And we have to pay from, I think since we commissioned it this month, we would be starting to pay from next year onwards on EMI basis. But we have done part payment to them. Only for the balance amount, there is a repayment structure.
Okay. And so what was the total cost for this project?
So the total cost for this project was around 13.57 crores.
Okay. And so what is the absolute amount of annual subsidy that you have received, let's say, since FY22, and how will it shape up going forward?
So the only subsidies we have received from the government is what is known as an interest-free loan. But unfortunately, we are not able to use that to our benefit because against that loan, we have to give a bank guarantee to the government. So that bank guarantee we have been issued by the bank with 100% margin. So technically, the loan has come to us, but again, it has been deposited with the bank for the sake of bank guarantee. We are in the process of, getting that released by, getting a bank guarantee sanction. It might take a while, but we don't know how long. But once it happens, even if bank gives us a bank guarantee sanction of with 25% margin, 75% of it will be released. So out of 22.46 crores of interest-free loan sanctioned by the government, around 18.5 crores have been received. The balance 4 crores will be received in the next 6 to 8 months.
Okay, sir. And sir, also there was some mention of some wheeling charges and transmission charges that were being waived off. Can you please talk a bit about that?
So technically, our plant basically has been installed before 2018, which means that for 10 years, there is no wheeling and banking charges. And the second plant was installed in 2022. For that plant, for 10 years, there are no transmission charges and certain other charges have been excluded. Now what we have added 3 megawatt is to the existing transformer itself, which means that in 5 years, there is certain amount of degradation, what has happened to the plant. Generally, when I look at the observation of the plant, we have not reached the full capacity based on the possibilities on the PV modules. So whatever gap we have seen, to that extent of the gap, we have added more of, the capacity. So technically, we have ordered only 3 megawatt capacity, by which our peak capacity will be within the limits sanctioned by the government. And we're expecting almost 45 lakh units to be generated out of this.
Okay, sir. And so one last final question. While going through the annual reports, I had an observation that salaries of some of the employees seem pretty low considering their past employment and total experience. So I'm just trying to understand, how do you retain them? Like, am I missing something from this?
No, typically all these employees whom we are seeing are locally from the local villages itself. In that region, See, cement plant is a very capital intensive industry, which means that we have a systematic computerized system in place. So it is not, I mean, even now, with the entire system is managed by computer operations, which means that, we need only a couple of highly skilled people. Otherwise, basic supervision is good enough to run the plant.
Okay, so would you say, yes, sir, please continue, sorry.
Yeah, so typically, like, it's a very small town around there. It's not very big, and, there are a lot of other benefits like, in-house benefits, there's a stay provided within the plant. So a lot of things do not show up in the salary itself. So they're able to manage with that right now.
Would it be fair to assume that this is somewhere around the industry standard and not much low compared to that?
In this region, yes.
Okay. That answers all of my questions. Thank you, sir.
Sure. Thank you.
Thank you. Our next question is from the line of Vinod Gupta, an individual investor. Please go ahead.
Hello, sir.
Hello, Vinodji. Boliye.
Congratulations, sir. And
Thank you
for
very
giving me this opportunity. So, sir, my question is, impressive EBITDA margin of 26.5% in quarter one FY24. What is the contribution to EBITDA and EBITDA margin expansion?
After expansion, you're saying, right?
Yes, sir.
So last year, I think we averaged around 30%. So this quarter is 26.5% only because the prices reduced by nearly 12%. So that ate away most of your EBITDA. But then after capex, we are expecting between 36 to 37% EBITDA margins.
Okay, sir.
The whole reason of doing this project is to cut down on a variable cost. So that is going to add to your EBITDA quickly.
Okay, sir. And my another question is, can you bifurcate cement and solar EBITDA margin and help us to contribute in EBITDA margin expansion?
Yes. So now, for example, this quarter, about out of 8.8 crores EBITDA, total EBITDA, solar EBITDA is around 8.10 crores and cement EBITDA is only 75 lakh rupees. So, can you hear me?
Yes, sir.
So this quarter, out of around 8.85 crore EBITDA, total EBITDA, solar EBITDA was contributing 8.1 crore and cement EBITDA is only 75 lakh rupees. That is mainly because of our, high fuel and power efficiency. So this is how the bifurcation has been made.
Okay, sir. Thank you, sir.
Thank you. Our next question is from the line of Manan, an individual investor. Please go ahead.
Yes, sir. Thank you for the opportunity again. I just had a few more questions. So,
please go ahead.
Sir, did we face any payment disruption because of general elections and also the monsoon season being so? कुछ debtor days में receivable में कुछ increase या कुछ हो गया है क्या?
Nothing is significant. I don't think so. We had any major issues during the election because we are not supplying to any government organizations, which we want to do it after capex. So we didn't see any disturbance or disburse during those times.
Okay. And sir, will we keep on adding our solar, capacity even after our 1 million ton capacity addition?
So general feeling is the management is going to keep adding efforts in both the directions, cement as well as renewable. How much and when, only time can tell. Because a lot of discussion happens, then we will have to, make certain provisions for the land, the financing, the funding and everything. So the best answer I can give to this question is yes, the management will look into expanding the, cement as well as renewable power as we keep going in time.
Okay. And so the 35 to 37% EBITDA margin that you said should come in around FY27?
Yes.
Okay. And last
some of it we should be able to see in FY26 itself, by FY27. Next year only we should be, because this year and if we start the plant by November, December, so by Q1 of FY26 we should be able to see some beginning of that, maybe not as much, but FY26 should be able to see that kind of high jump.
Correct. Okay, okay. That's nice. That's good to hear. And last question would be, sir, I'm pretty, like, I don't know that much tax rate on all. So I just wanted to understand that our tax rate has been little erratic. So, like, will there be some guidance on the tax rate in FY27, something like that?
Why would you say that our tax is erratic? So what has happened in our plant is, we have a huge depreciation carry forward from solar investment. See, solar investment is one industry where the asset turnover ratio is extremely low. Government is promoting solar, which is why the best way they can promote it is by allowing us to go for very high level of depreciation. So in my classic case, what has happened is, since our depreciation is loaded in our income tax, our tax rate, we are presently giving tax only as MAT, and for next several years it is going to be MAT itself, since we have a depreciation loss of around 100 crores in the books. So the real income tax will come maybe after like 4 to 5 years. Maybe that is the purpose you are seeing the tax rate is uniform like earlier. So it is going to be similar next year, maybe 3 to 4 years. After that, once we, once our depreciation is completely used up, we would look into a uniform income tax rate.
And that would be around like general 24, 25, 26. Something
Correct,
around that.
Correct.
Okay. Only this much, sir. Thank you so much. Thank you.
Sure.
Thank you. Our next question is from the line of Aman, an individual investor. Please go ahead.
Good afternoon, sir. Can you hear me?
Yes, Aman, I can hear you.
Okay, sir, I had a question regarding our debt. I just wanted to understand what is the debt we carry on our books as of today, and what kind of repayment plan are we looking at for the same?
So debt appears for the top line that we are doing, the debt appears high, mainly because most of the debt is coming from investment in solar energy, which is not generating revenues. So, for example, now we have taken a new debt of around 80 crores for the new capex. Excluding that debt, had we not done the capex, our debt profile would have been around 125 crores. Out of 125 crores, almost 90 crores is 90 to 95 crores is attributed to solar. The cement debt is going to be only about around 35 crores. I'm talking about the term liabilities, excluding any working capital liability. So our debt profile, even though it looks a little skewed away from the industry standard, it is still digestible only because of the solar energy what we're using. Our EBITDA margins are very high. You'll never see these kind of EBITDA margins in any cement plant. You look at all the top class cement plants, their EBITDA margins are hovering between 10 to 12%, but we are touching around 35%, mainly because we are having this benefit of renewable power. So as we complete the capex, there is going to be increased cash flow. Like I said, some part of it will go towards increasing capacity in both. The balance will go to earlier closure of debt and reduction of debt. So that's a plan basically.
Right. So
Sorry.
We have about 190, 200 crores of debt on the book as of now, right? That's correct.
That is including the new debt that we have taken for the capex,
yes.
whose operations are not coming to place. Yes, but you're right. An additional 80 crores has been added.
And the interest that we are paying out every quarter is in the range of about 4 to 4.5 crores approximately. Is that the amount one can expect even going forward? I mean, is there any scope of the debt increasing or the interest expenses increasing going forward?
So you're talking about quarterly interest rate, right? Quarterly interest?
Quarterly, yearly, whatever. So you have taken on this debt for the expansion, for the solar power plants, etc. Just very simply put, the question is, will the debt increase going forward, or would it now go on a downward trajectory, thereby interest rates or interest payments also every quarter as your new plant starts working? I'm guessing it will only go down going forward.
Absolutely. So if you look at, since the expansion has taken place now, if you look at last 2 or 3 years of our finance cost, it has shown a downward trend. So like FY22, my finance cost was around 19.2 crores. then it came down to 18.7 crores. So again, last year it came down to 16.9 crores. So this year it could bump up a little bit because of the capex. But yeah, there is always a general trend. If you look at last 3 years, you'll always see that debt is going down because we are repaying always on time.
Got it. And how many years have you factored in to sort of pay off this debt?
So the longest debt is that we have taken for solar, and that will take probably another 8 to 9 years. So typically, from what I see, our first, like what we have sudden debts of term loan 1 and term loan 2, we will be completely repaying it by some of it by beginning of next year, some of it about mid of next year. So we are going to, the amount of cash flows that we will save on repaying this debt of 3 debts, what is going to happen is almost equal to the repayment schedule of the new debt, what is going to come up in the books. So if you look at the math, our actual cash flow is going to remain fairly constant, whereas our revenue and EBITDA and profitability will increase. So for example, my term loan 1, which is term loan 1 and term loan 2, together I pay around 50 lakh as a repayment per month or 6 crore per year. And then I have a GSA loan for which I pay around 5 crores. So this put together is about 8 to 9 crores debt repayment, which will get over by March 2026. So that eventually will be replaced by the new debt and repayment of this what I have taken. Right. So yeah. So only for FY25, the repayment and debt will go high. After that, it will start going down drastically.
Understood. Thank you. This is helpful. On the EBITDA margins, you suggested it will be between 36 and 37% once your new plant sort of starts working. The effect of this you suggested would be fully seen in starting FY26 itself. So for anything new to scale up, is this a realistic expectation that within weeks or months it will start giving you this kind of margins?
So which is why I didn't mention that we may not be able to see that in the first quarter itself. There could be some, like TV issues and all those things. So overall, that's a direction we are going. If not 35%, maybe we will be in the range of 34, 35. But eventually, we will have to get there. So that the whole objective of this capex is to cut down your variable cost significantly. So ultimately, it has to impact on the positive side of the EBITDA itself.
Got it. Well, 2 quick questions. One is around the demand. You suggested in your previous calls that 1 million capacity added is not a big number. So looking at the kind of government initiatives we have, the infrastructure development that is going on, in your reckoning, you feel that this demand will be absorbed easily within the radius or the markets that you serve in over the next few years?
Absolutely. So you're right. This is a typical thing. 1 million ton is still not a very large capacity. So with this 1 million ton, what I'm adding to myself is increased margin, which means that I have a deeper pocket to reach out for a better sales and marketing programs, better marketing reach, supplying to the larger dealer network who would like to consume at a higher rate and giving better discounts. So we are pretty confident as a management that cement itself, due to initiation by the government and due to the fact that it is just 1 million ton, the sales should not be a major challenge in coming days.
Super. One last question, sir. I believe you have a land holding or land holdings of about 260 acres. Is that understanding correct?
So land holding is, you're talking about existing land where we have cement plants.
The land the company holds is about 260 acres. I remember listening about this on some other call. Is that accurate?
Absolutely. So let's see. So we have 42 crores and around 15 crores from cement too. Then we have 160 crores. So yeah, 160, 40, 200, 215, 220 is what is showing me. So typically that is what it is. It is what it is there. Maybe not 260, but 215 or 220.
Okay, 220 acres. And what would be the value of this land, sir? I'm just trying to understand, just for my understanding, in these regions.
See, the market value is going to be extremely high because both my cement plants are located right on the highway. In fact, one cement plant which we have on the first plant, which is what we call the plant what we have taken in 1995. There is a township coming around there.
Right.
And we haven't done the valuation internally, but all these lands, they're completely for industrial use. I wouldn't be able to tell you an exact figure, but I can give an approximation. So one plant to whatever we have 40 acres is right on the highway. They're going to make it a big 4-lane highway, about 40 acres. It is easily going to cost, the price is around 1 crore rupees per acre over there. And that 15 acres what we have in plant one, around the same price. This 160 acres what we have for a solar plant, the value is around 25 lakh rupees per acre. So the math says maybe around 100 crores.
Okay, super. This is great to know, sir. Wishing you all the best. The company is set up for some exciting times ahead, so look forward to seeing this grow further. Thank you so much.
Thanks a lot, Anand.
Thank you. Ladies and gentlemen, that was the last question for the day. I now end the conference over to the Jainam Salva for closing comments.
Thank you everyone for joining the conference call of Shri Keshav Cements and Infra Limited. If you have any queries, you can write us at research@kirinadvisors.com. Once again, thank you to the management team and participants for joining the conference call. Thank you.
Thank you.
Thank you.
On
Thank
behalf
you,
of
everyone.
Kirin Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.